Hey class, Mr. V here. This is going to be the intro to adjusting entries, and we're going to do some prepaid adjusting entries in this video. This is the beginning of chapter 8 in this course, so I'm excited to jump into this one. Learning goals, success criteria. We're learning to record adjusting entries for a service business, and I'm going to tell you what adjusting entries are. You're going to succeed if you can tell me what they are, explain why they are completed, why they're relevant, and even record a couple prepayment adjusting entries. So maybe even by the end of this video, being able to sort of understand some basic um, recordings for adjusting entries. So the first thing I want to do in this video is talk about something called accrual basis accounting. You've already been learning how to do this. Okay, you've been doing accrual basis accounting. So thinking back when you learned about the revenue recognition and the matching principle, these two gaps, you were learning accrual basis accounting. Accrual basis accounting says that revenues and expenses are recorded in the period that they occur, not when the cash is paid or received. So think back to chapter 5. If you saw a transaction that says something like, we performed a service for a person today, and they're going to pay us back in a month and a half. Hopefully the revenue recognition principle will guide you to say, okay, well, look, we have to actually credit revenue today because we're earning it this month if it's a monthly accounting period. And even though they haven't paid us the cash yet, it doesn't matter. We recognize the revenue in the month where it occurs. The same basic principle applies to expenses. Whenever the expenses are actually being used and helping us to earn money, if there's expenses that are actually happening this month, even if we don't pay them back for a couple months, we still have to record them in the periods where they were actually earned. And what we're going to see today is that even if we already paid for the expenses like months ago, we have to actually debit the amount of expense that happened this month with an adjusting entry to make sure that things are done accurately. So hopefully that'll make some more sense as the video goes on. The opposite of accrual-based accounting is cash-based accounting, which doesn't really make any sense for us. This is when revenues and expenses are recorded, not when they actually occur, but when cash is paid, right? So accrual-based accounting is considered much more effective because it gives you better information. If we know that revenues are being like recognized on our income statement and therefore contributing to profit or loss in the months where they actually occur, that's way more important. Everything we have is going to be much more accurate, our financial statements, by the time we get to actually prepare them. All right. So that's why accrual-based accounting is really important. So I'm going to skip past these slides because I just sort of talked about them. This is basically just connecting accrual-based accounting to the revenue recognition principle and the expense recognition principle. We recognize them in the months where they actually occur, the revenue expenses, not when the cash is exchanged. So as an example, imagine that in year one, like December, let's say, you pay $50,000 cash as a business for all the paint and supplies and the salaries. If you're like a painting business, and we bill the customer $80,000. All right. So we're doing this all, let's say, in December. We spend $50,000 to paint the house. The customer pays us $80,000, but they're not paying us back until maybe midway through January. So during year two. So the way we would record this transaction, the way that we like, is accrual-based accounting. So if we actually painted the house in December of year one, then we put the revenue in year one and the expenses in year one, which makes sense. Cash basis accounting, the opposite, which we don't like, would be since the customer is not actually paying us the cash until year two, even though we actually painted the house in year one, we're going to recognize the revenue in year two. So that's bad. That doesn't make as much sense. That revenue belongs in year one because our business spent $50,000 in expenses to paint the house in year one. If we put the revenue in year two and the expenses in year one, well, that's going to make our profit really unreliable. It's going to make year one look like a lot less profitable than it actually is. It's going to make year two look a lot more profitable than it actually is. The revenue and expenses have to go together. So why am I spending all this time explaining something you've already kind of learned? Well, because if you understand this, then adjusting entries are going to make so much more sense. So I'm going to do something a little bit different here. I'm going to actually do the problems that are going to help you learn adjusting entries. There's 3 examples in this video. I'm going to do them at the beginning, but I'm not going to explain them in too much depth because I think adjusting entries make more sense if you actually see them done. So let me try this. Okay, so if you're ready, here, 2 transactions. So the advertising agency bought the supplies for $2,500 on October 4th. So October 4th will look like this. This one is not an adjusting entry. It's just a normal accounting purchase. So you already kind of know it. We bought $2,500 worth of supplies. So our cash goes down and our supplies go up. The adjusting entry is at the end of October. So we bought these supplies on October 4th. At the end of October, when our accounting period is about to end on October 31st, we count the supplies, and we realize that even though we started with 2,500, we've actually only got $1,000 of supplies left. So here's what the adjusting entry will look like for the month. We're going to record the expense this month because this is when we actually use the supplies for $1,500. And we're going to debit, therefore decreasing the value of our supplies asset account by $1,500. Whoops, actually, I'll show you that's the account later. So I'll explain that a little bit more later. See if you can make some sense out of it for now. That's our first adjusting entry. Okay, our second adjusting entry. So on October 3rd, so this is not the adjusting entry. This is just the first purchase. We paid $600 for a 1-year fire insurance policy. All right. So I'm going to credit cash for $600. And I'm going to debit prepaid insurance, which is a new asset we're going to look at. It's an asset because it has value and we paid for it and it's going to help our business. So prepaid item like prepaid insurance, prepaid expense is an asset for 600. It's our first transaction. But the adjusting entry, so this is October the 3rd. At the end of the month, we're going to make an adjusting entry. Here's what it's going to look like. So it's a 12-month policy that was worth $600. We've used a month of it. So the new value of prepaid insurance on the new balance sheet should look like this. So what we're going to do is we are going to debit insurance expense because it's the end of the month for the month of October by $50. Okay, and we are going to credit our asset prepaid insurance, which up here we bought it for $600. We're going to decrease that by $50 at the end of the month. So this is our adjusting entry. I'll explain that a little bit more slowly later after talk about adjusting entries and what those are. Okay, so I thought it was on pause. So the final example that we're going to do this video is here. We received $1,200 from a customer for accounting services to be completed over the next 3 months. On October 3rd is when the customer gives us $1,200. So on October 3rd, the customer gives us $1,200 cash. So obviously we're going to debit cash for $1,200. However, we're not going to credit revenue because we've not actually done anything for them yet. So far in this course, all of the examples you've seen with revenue have been like we've already performed services for them and they paid us money. So normally you would just debit cash and credit revenue. But so we can't credit revenue yet because we haven't actually done anything yet. On October 3rd, we just collected money for something we haven't earned yet. So we are going to credit the second new account today called unearned revenue, which is a liability. It's a liability account. I'll explain why in a bit later for $1,200. Let's say at the end of the month, as of October 31st, $400 of the work was completed. So this actual prepayment of revenue cash from the customer, they paid us $1,200 on October 3rd. So the accounting period is about to end on October 31st. Okay, by October 31st, though, we don't want to leave the unearned revenue account at $1,200 because we've actually done $400 worth of the work. So since we've done $400 worth of work this month, now we're going to credit revenue for $400 because over the month of October, we've done $400 worth of the revenue for them. And we're going to decrease the value of the unearned revenue account also by $400. Okay, so unearned revenue, which is like a liability because we got cash, but we kind of owe them. So unearned revenue is kind of like a liability. Started at $1,200 in October because it's now October 31st. And we're doing an adjusting entry. We've actually done $400 worth of that service. So we're only going to put $400 worth of the revenue in the month of October, and that's going to leave unearned revenue account with an $800 balance. All right. So sorry for those previews. I'm taking a chance with them. They should not make perfect sense right now. If they do, that's incredible on your part. Let's talk about what adjusting entries are and see if those make sense. So adjusting entries are journal entries used to bring all of the accounts up to date. Those 3 examples I just did, each of them, whether it was the transaction with supplies or with the prepaid insurance or with the unearned revenue, revenue that we hadn't earned yet. In the case of all three of those adjusting entries, the reason we made the second entry was because October was ending. It was October 31st. And if we didn't make the adjusting entries, then supplies would be overstated. It'd be too high because we actually used up a bunch of supplies. Prepaid insurance, all that insurance that we paid for, if we just left the value of the asset at 600, it would be inaccurate because we actually used up a twelfth of it, so we only had 550 left. And unearned revenue, that liability account, we actually earned some of it back. So these adjusting entries are done to make the accounts up to date, to bring them up to date and make them more accurate. Okay, they're also done because of the gaps. The gaps say revenue recognition and matching principle that we have to recognize revenue or expenses in the months where they actually are earned or they take place. Okay, so we'll come back to that and hopefully that'll make some sense at the end. So why are we doing these adjusting entries? So the reason why we, at the end of the months, we'd make some adjusting entries to make sure our accounts are accurate is because we want the account balances to be accurate because decision makers need to know if they're accurate or not. Net income or net loss needs to be calculated each month. So let me use the supply one, for example. Remember we counted the supplies and we actually used some of those supplies in the first month. So we counted the supplies at the end of the month and we actually used $1,500 worth of supplies. If we don't debit expenses for $1,500 worth of supplies, then we're going to be overstating our profit because we actually should be debiting supplies if we use supplies to help us earn money this month, or prepaid insurance. Okay, we used up some of that asset, that prepaid insurance account for 600. We used up some of it this month, so we should be debiting insurance expense because that's an expense that we use to help earn money this month. And revenue. Okay, the revenue one. So they paid us for the revenue in advance, so we put it into an unearned revenue account, which is a liability account. If we didn't make an adjusting entry, then we wouldn't be recognizing revenue that we actually earned this month, right? So it's about making things accurate and to follow gaps. And I still rule of thumb too, you'll notice by the end of this, is that each adjusting entry that you just saw, and each one that I'll go over them again, affects at least one income statement account, like expenses or revenue, and at least one balance sheet account, like supplies, which is an asset, or prepaid insurance, which is an asset, or unearned revenue, which is a liability, right? And the revenue account affected in each was supplies expense, okay, which is an income statement account. Prepaid insurance affected insurance expense, and unearned revenue, we had to credit revenue for the $400 that we actually did in the month. So these are all the income statement accounts, and these are all the balance sheet accounts. So it's always going to be one and one. That'll be a nice way to help. And again, I'll go through those ones just a little bit more clearly after I'm done just explaining these, which I almost am. So I've already been through some common examples that can cause accounts to become out of date, which is why we do adjusting entries to bring accounts to accuracy by the end of the month. So some business events are not recorded every day. So supplies. You see how at the end of the month we counted our supplies and we realized how many dollars we had left. Theoretically, you could do that every 5 minutes if you want to. You could say, "Oh, we just used another, 5 staples. We need to debit supplies expense for 3 cents." Well, that's not realistic, but it's also not good if you wait like 6 years, if you buy all the supplies at once, and then you're going to wait 6 years is extreme, but if you wait 6 years to actually count your supplies, and then 6 years from now, you say, "Oh, okay, we got debit supplies expense for $300,000 because you haven't debited supplies expense in years." That's not good either. So adjusting entries are our way of counting at the end of the month, figuring out how much have we done and used, and then making little journal entries that will help increase or decrease the value of the counts of the balance sheet, like supplies, to make them more accurate. Okay. Also, some costs are not recorded during the accounting period because they expire with time rather than through daily transactions. So this refers to prepaid insurance. All right. So prepaid insurance we paid for at the beginning, but it just expires over the course of time. So at the end of a month, what we should do is decrease the value of the asset prepaid insurance that we paid for ahead of time, decrease its value just a little bit to reflect the fact that it's no longer worth 600. It's not only worth 550 because we used a little bit of it. Okay, so the last two I'm going to skip for now because they're not going to be in this video. And similarly, I just wanted to show them to you in case you're interested. Similarly, where I'm only going to talk about prepaid expenses and unearned revenues in this one, which is all I have been talking about. The actual accrued expenses and accrued revenues, we'll wait a couple days to talk about those until we're really good with all of these, and then those will make sense, and that's pretty much all we're going to learn for adjusting entries. All right, so let's do those examples again. So here's how I'm going to do them. I already did them. I'll show you again. Try to keep this in mind. So prepaid expenses are costs paid in cash before they are used. Prepaid expenses are current assets. All right. Prepaid expenses expire with the passage of time, like insurance goes down a little bit every month, or are used up, in the case of supplies. The way these work is when we use up some supplies, we debit supply expense. Or if we use up some of our prepaid insurance, we debit prepaid insurance. And then the credit would be decreasing the value of the prepaid asset. So prepaid insurance is a prepaid asset. Supplies is a prepaid asset. We've already paid for it, but we're going to use it period by period. And every time we use it, we decrease it a little bit by crediting it, because that's how you decrease the value of an asset. So here was the first question again. I'll just go straight to the answer, which I've already shown you. So here's the question. Here is the answer. On October 4th, we bought the supplies for $2,500. So this is not an adjusting entry. This is just a normal accounting entry. We spent $2,500 on supplies. So pretty standard transaction here. But at the end of the month, we count our supplies again, October 31st, and we realize we only have $1,000 of supplies left. Okay, so we started with 2,500 and we only have $1,000 left. So how much did we use up over the month? Well, we used up $1,500 worth of supplies. That's why we have to debit supplies expense for $1,500, because we used them up to help us do business. And our supplies, which if we don't do an adjusting entry at all, our next balance sheet is still going to say that supplies is 2,500, but that'll be wrong. Okay, our supplies should say 1,000 because it's all we have left. So we credit supplies by 1,000. Okay, and that will bring the new balance to we credit supplies by 1,500, and that'll bring the new balance to 1,000. So if it helps, think about a ledger. Here's our supplies ledger. Okay, so on October the 4th, we purchased 2,500 in supplies, so we debited supplies for 2,500. On October 31st, the adjusting entry, we credited it for 1,500 because that's how many supplies we used. So the closing balance of supplies is going to be $1,000. Which is right because we counted and that's how much we have left. So that's how that whole process worked there. Okay, so that's one example. The other example, which is similar, is insurance. So here was the question and here's the answer I went through earlier. We bought the insurance on October 1st or October 3rd, but it took effect on October 1st. But so on October 3rd, the accounting entry is prepaid insurance, an asset we bought for $600, and we spent $600 in cash. So this is an adjusting entry. Adjusting entry is something we do at the end of the period to make sure it's accurate. So on October 31st, we can't just simply do nothing, because if we do nothing, then the value of prepaid insurance on our October 31st balance sheet is still going to say $600. But that's misleading, because $600 was a 12-month policy and 1 month has gone by because it took effect on October 1st and it's now October 31st. So the adjusting entry should look like this. We should credit prepaid insurance for $50 because we need to bring down its value by a 12th because we've used up the 12th of the policy. And we debit insurance expense because that's what we got out of the $50 effectively that we spent. It's a $50 expense over the course of the month for insurance. And the new value, naturally, of prepaid insurance will be $550. But this is the adjusting entry right here. Hope that makes sense. And the last one, unearned revenue, went through a little quickly. This was a tough one, but unearned revenues are liabilities, also called deferred revenues or future revenues. You might see that. These appear on the balance sheet. So this is when we receive the cash today, okay, for services, it's meant to be a hand, that we're going to do later. This is the opposite of what we've been seeing. Normally, to this point in the course, you're seeing like we're receiving the cash today for services that we performed today or yesterday. So the service has already been done normally. But now we're talking about what if we get the cash up front? Cash today, service being done later. I showed you the answer to earlier. What we do is we can't simply credit revenue today. We can't credit revenue today. Normally, we would do cash debit, revenue credit. We can't do this. Why? Because we haven't actually earned the revenue yet. So if we credit revenue for the whole amount, it's very misleading. It's not accurate. It's going to make it seem like we earned the revenue this month, but actually we still have to earn it because maybe there's 2 months left and we're going to do a third of it next month and a third of it the month after. So this transaction here, just to review, and here's the answer again. This transaction here involved $1,200 received up front, but we've only done $400. We only did a third of it. We only actually earned a third of this revenue in October because it's going to be fully completed by December 31st. And it says here how much remains in the liability account for unearned revenue, assuming that we've done a third of the work in the month of October. Only $400 was completed. So the initial transaction, this is not adjusting entry, this is just them giving us cash, was this. This one right here is the adjusting entry because, again, at the end of the month, if we don't do anything, the unearned revenue account, that liability account, is going to stay at $1,200. But that's wrong because we actually don't still owe $1,200 in revenue. We've done $400 in revenue. So what we're going to do is we're going to credit revenue for $400, as you see right here, because over the month of October, we have done $400 of revenue. So that should be on our income statement. That should add to our revenue for the month. All right. And then we're going to debit the unearned revenue because that's a liability account. Unearned revenue, the liability account. The day we took the money got credited for $1,200, as you can see right here. But over the course of October, we have earned $400 of that revenue. So what we need is the new balance to be only $800 because that's more accurate. We only owe $800 in revenue now. We've already earned $400. That's why this transaction involves us reducing unearned revenue by debiting it for $400, and we're going to recognize the $400 in revenue that we actually did this month. So that's the point of the transaction. Okay. Oh, this is actually my first video. It's my second version. Was 23 minutes. I tried to make this one shorter, but yeah, it's a whole preview thing I did. It wasn't very efficient. So why don't you try this question right here? This is a little tester. Again, it's one video. If you can actually do legit adjusting entries after just watching one video, that's really great. So if you can even do part of this, or you're kind of getting where you might want to go, even if you can't do it yet, that's super okay because you haven't done any practice or gotten any feedback yet. Give it a shot, and here's the answer. Okay, so I won't go through all of these. I'll just give you the quick notes in case anything was confusing. So for number one, the insurance policy worth $1,200, which is what it was worth before, was purchased on March 1st, but it's now March 31st. Okay, so it's now March 31st. It's the end of the month. And it's a 12-month policy. So what we need to do is debit insurance expense for $100 and credit prepaid insurance to decrease the value of paid insurance by $100 because that's what we've used the 12-month policy over the course of this first month. Second one involves supplies. So supplies we count at the end of the month and $800 worth of supplies, but beginning or what our balance sheet has before the adjusting entry, it says we have 2,800, but we actually in reality only have $800 of supplies left. So we need to make the supplies account accurate. So if our asset of supplies at 2,800, we need to turn that into 800. So we would credit supplies for 2,000. Credit supplies for 2,000. Whoops. And debit supplies expense is 2,000 a month. And unearned revenue is the final one. So unearned revenue at the beginning, if we don't do anything, this liability account, we've already collected money, $9,300 worth for revenue that we haven't earned yet. All right. But what you're being told is that over the course of March, it's the end of March currently, we've actually already earned a third of this. So we probably collected this at the beginning of the month, and we're done with earning a third of this. So we don't want to leave this liability unearned revenue at 9,300. That's not accurate. We actually only owe them 2/3 of that revenue left. So what we would do is we would credit service revenue for 3,100 because we've actually earned 3,100 in revenue this month. So that should count towards our revenue figure and help our income statement. And we would debit unearned revenue because unearned revenue isn't 9,300 anymore. It should go down by 3,100. We actually only owe them 6,200 in unearned revenue left. So this is our adjusting entry to make unearned revenue accurate for one, by debiting it down to what it actually is, and number two, to recognize revenue in the month where we actually earned it. All right. This video is exactly the same length as my first one. Wow. Okay. Anyway, so I'll give you some time in class to watch this, and yeah, thanks everyone. Let me know if you have any questions. And thanks again for practice this for a few days.